Hello, everyone, and welcome to this great panel inside the LP decision room. So I will introduce myself, and then I will ask our distinguished panelists to introduce themselves for the audience. So I'm Ekaterina Almasque, and I'm a founding partner of BlankPage Capital, which is a venture capital growth platform. We are investing in ambitious breakthrough technologies and deep tech companies out of Europe and the UK that want to scale globally. So I just tell a little bit of a personal story. So I have been investing in venture capital since 20 years. And, I have done quite a few things in my life. So I remember, figuring out quite a lot of complex things in my life. So I lived in 10 countries across 3 continents. And I had to figure out how to live on my own when I was 19. I had to figure out how to present to a board of Siemens when I was 20 and convince them to change direction. I had to figure out how to invest in technologies ahead of their technology waves, whether it's AI, whether it's cloud, whether it's quantum computing or anything else. But by far, if you ask me, what was the most complex thing you had to figure out in your life? And I would say it's fundraising for the fund, not for the company, for the fund. To navigate this very complex ecosystem and relationship with LPs and figuring out who actually is really suitable for your fund and who wants to partner with you is really complex things. And that's why I'm very glad to be moderating this panel today, and I would love to hear, and I will ask some questions, some very difficult questions to our panelists, about how do they see this and how do they advise GPs to think about this environment. So with this, please introduce yourselves, just give you a little bit of your background and what you represent.
Thank you, Ekaterina. So, Giuseppe de Filippo, as you will hear, I'm 100% Italian, and I lead the private market business for Julius Baer, almost unpronounceable name. It's a bank, it's the second largest Swiss bank. It happens to be the largest pure play private bank in the world. And we, among the many things we do, obviously our clients have a distinct interest in private markets.
Thank you.
I'm Pavel Dvorak. I'm at the EBRD, the European Bank for Reconstruction and Development. I'll try to be brief, but just a very quick intro into the EBRD. It's an institution that was set up in the early 90s to support the development in private sector and market economies in Central and Eastern Europe. The region has since grown. It now includes Turkey, parts of Africa and Middle East. The bank operates across sectors and products, but and it's mainly project finance, debt project finance, but within that we have our sort of sizable equity group, and within that in our team we invest in funds, in my case venture capital funds, focused on the EBRD region. The tickets we write are probably a bit smaller compared to the UK market, etc., but it's quite sizable in our markets, as we 10 to 25 million euro commitments, but it can be significantly larger. And we are always we like to be cornerstone investors in the funds where we invest.
Thank you.
Hi everybody, Mark Sims, I'm Head of Development Equity at the British Business Bank. Hopefully you all know what the British Business Bank is, because I think Leandros was up here a few minutes ago telling everybody all about it, but we will be deploying across venture and growth about over 2 billion in the next financial year, so it's pretty significant, one of the largest investors in European venture. I head up the Development Equity, which is sort of targeting launching new fund managers into the market, and backing them and trying to scale them. I've been doing this for 13 years. I still haven't seen one fund go a full cycle. So it is a long journey that we're on with venture. So there you
go. Don't start with the bad news, Mark. Hi, I'm Joe Schorge. I'm the founder and managing partner at Isomer Capital. We're a GP. We're also an LP. So we raise funds and we invest in other funds. We do 3 things really. We've invested in 100 early stage funds so far, all across Europe. We then co-invest in companies together with those funds, and we buy secondary pieces of both. We have an underlying portfolio today of 3,000 companies. 55 of them are unicorns so far. So this says something about the great productivity of everyone in this room and the European ecosystem.
Thank you. This is fantastic. So we are very lucky that we have really representation of many different asset classes here, from private banking, development bank, government, and also fund of funds. So I want to start with a very generic question. So when a GP walks into your room, and please talk from your perspective, you have probably very different perspectives, like when a GP walks into your room, what are the 3 questions you want to ask? What are on your mind? And are these questions today different than they were 3 years ago? Let's start with you, Giuseppe.
Oh, okay. So the 3 questions in this order, more or less, are: I want to know, who are these guys? Who are the people? What drives them? What motivates them? What makes them special? I assume, given our panel, many of you are GPs looking for money. So 9 out of 10, I always hear the same thing. We are ex-founders, ex-operators, or we have special access, which is what I hear all the time. That's not very special. And given that venture capital that's has the highest dispersion of returns between any asset class of any investment, just to give you, I'm a PhD in physics, so I have to give you some numbers, I guess. The distance between the top decile and the bottom decile is 40 percentage points in IRR. That's quite a bit. And the only constant across all the cycles are the people, right? So that's one point. The second question is, again, people show up with a perfect pitch book. I'm sure some of my colleagues know that, which I am not interested, again, at all. The only thing I care is I want to see line by line every single company they invested in and what are the marks, right? So because so many companies haven't raised money. Obviously, we focus on fairly large funds which invest in fairly large companies. And many companies have not raised money since 2021. And these ones in the secondary market are trading at 68% discount. The one that last time raised money in 2022, they trade at 52% discount. So if a GP cannot tell me how many companies have not raised money, that's bad. And last question is, what is the path to liquidity? What are the exits? How they plan to give me back the money? That's the only thing I care, right? We are not into this for generosity. That's, sadly, I'm a banker, so that's what I'm paid for. And what is different? 3 years ago, we were always asking about what will you invest, what is the pace of development, etc. Now it's all about the health of the portfolio and what are the exits.
Yeah, so I think ultimately, I'm not sure how much actually I will add to what Giuseppe just said, because it will probably be in the end quite similar. I mean, ultimately, I think what LPs look at will probably always be similar, right? It will be sort of the team, strategy, market, alignment between that, right? Alignment with investors, sort of the governance arrangements, and sort of the quality of the operations of the team. But I would say that if you're asking about the first questions, right? I mean, it will always be about the team, and so very similar to what has just been said. Basically, kind of who they are, what their background is. How, in what way they are different, from everyone else, kind of the uniqueness of the team, and maybe on top of that, for us, there are some, let's say, strategy, basically alignment with our strategy and our policy restrictions, basically, which mainly relates to geography, so the geographic focus, which we have quite a specific one. And to some extent the size of the fund, because again we are relatively big organization, which, I mean, there are fixed costs with writing, commitments to funds. So the fund needs to be of a certain, typically it would need to be a, certain minimum size, basically. But the key questions, I think, are really about the team and the background. And in terms of what has changed, I think, I don't think that much has changed, about these sort of key questions, the first questions. But maybe I would just mention differentiation and sort of, to what extent the team is differentiated from others in the market. I think it's becoming even more important. I think it's become more important, and also in the context of the increasing maturity of the market in our region. And then, I mean, that would be, I suppose, quite a bit further down the list, but things like, well, I think approach to liquidity, maybe in venture. I mean, obviously we need to understand that everything takes a long time, and it's a very long-term asset class. But in the context of the experience, the recent experiences, maybe it's also in our portfolio. It's becoming, let's say, more important to discuss. Approach to taking liquidity when it's available, right? So it's not necessarily that everyone has to create a huge DPI immediately, but it's, when there is liquidity, what's their approach? And it's not necessarily that there would be one correct answer to that, right? But it's good if the team has some sort of some thinking behind that, some approach to that. And maybe, again, even much further down the list, but things like leveraging AI, actually, and using AI tools for the fund operations, for sourcing. But again, these are quite sort of small points, I would say, compared to really the characteristics of the team and the background, the motivation, etc., what has already been said.
Mark?
So yeah, generally I only back first-time and emerging managers in venture capital, so it's quite hard to go on, the track record of what people have done, particularly because it's pretty nascent, so you can't go on that. So one of the things we try and understand, and to the same point, we try and understand the people of what they've done. But I think in the last panel, and when somebody asked what should you do, and you should follow your passion, we're trying to find people that are following their passion, that are trying to tackle problems in their areas where they really, really understand them and are committed to them and want to tackle these problems long term. But one of the questions that we'd always ask somebody is why would people want to take your money? If you're a VC and there's this amazing deal, founders have got a lot of options. Why do they want your money? What makes you stand out? What makes you in that market that they say, well, I want that VC in my cap table? That's a really fundamental question that you should be asking yourself if you're raising a fund, because everybody comes in and talks about, well, we've got access to deals and we know all the deals and we do all that. You've got to get in the good ones and they've got to want you in it. So you need to be thinking about what you can bring as value add into those deals. I think that's one of the fundamental things. So yeah, you've got to be amazing, you've got to have passion, you've got to know your industry, but ultimately you've got to bring something to the table as a VC that you're not just cash. And we're really interested in that. That's one of the things that stands out. And that has not changed for a very long time. It's the same story. So yeah. Thanks.
That's right, great point. And Joe, what about you?
Well, there's nothing to disagree with on that panel. Mark, I find your comment really interesting. It's a question we've asked a long time. And what you're also hinting at is that the market's maturing, which means money becomes a commodity. So 10 years ago, just having a fund, having money was a competitive advantage. It's not today. Money's a commodity, and therefore, why would the great founder want to work with you as opposed to someone else? And that gets back to differentiation. But to come to your original question, what do we ask? I might answer the question a very different way. What do we ask? Who are you? What are you trying to do? And what have you done in the past that equips you for that? And everything hangs off that. But the thing I think it's hard for GPs to know, particularly new emerging GPs, is if you are a professional LP who does this a lot, you see a lot. So as a new GP, you're quite excited that you've figured out how the GP-LP format works, and you've spent time with lawyers and you've spent time with founders, and so you tend to explain bottom up. And for certain types of LPs, that makes a lot of sense because they're new to the market. But I would suggest that you have to, all of us, I don't mean you, I do the same, you have to gauge your pitch to the LP. Because half of the sale is what you're selling, and half of the sale is what they're buying. And so to use us as an example, which is true of these people on the panel, we've met just over 2,000 GPs to invest in 50. So we don't want to know the basics when you come in, right? And that's kind of different. And I might compare it to like buying a car. If you would go buy a car, you decide today I'm going to buy a car, well, you have a lot of choice. And so when you go in the car dealership, the questions you're asking are not how many wheels does it have. There's kind of a standard for how many wheels a car has, right? How many doors it has. So cars, when they're sold to you, are, well, this one's exciting to drive. This one goes fast. This one's very efficient. This one uses electricity, not petrol, right? And that's a little bit how the funds market is as well. And so my suggestion is that you consider the LP on the other side and ask about them first before you launch into your story. And certainly don't burn half your meeting in how many wheels your car has and those sorts of things.
This is a great point. Joe, let's stay with you for a while and dive a little bit more into this seeing a lot of pitch decks. I think you're fund of funds that probably you see the most amount, largest amount of pitch decks across Europe. What separates for you the top performers or top decile, whatever you call it, top funds from the rest? And do you see sometimes situations where the fund actually has a strong performance, but you are not inclined to invest, and why?
Yeah, there's a lot there. I guess the first thing I would say is fundraising is a different skill than investing. And you see firms that are great at one and not great at the other. And that's a kind of common thing in the market, right? People who pitch extremely well and are great salespeople might not have invested well, and vice versa. Sometimes we see the most horrible pitch, but they're great at what they do. So that's our job. I think that's all of our job, is to somehow look through whatever the pitch is to find out is there value there, right? But about what makes a good pitch, that question, I remember this old quote, "I'm sorry that I wrote you a long letter because I didn't have time to write you a short letter." Right? And that means that to crystallize your message, fundraising is storytelling, and to crystallize your message down to the memorable, important points takes vast amounts of time and effort. And we can smell that. So when you get a pitch book, if it's very clear and tells the story and it's quickly digestible, don't forget, we all have shorter attention spans than ever before, right? So you have to grab your LP in the first page or two. You have to earn the right that they read the third page and the fourth page and the fifth page, right? And so condensing your message down to the vitals. What does someone need to know and what gets them excited about your fund? Does that mean it's a top decile fund? I don't know. But a top decile pitch gets the reader very, very quickly to, there's an opportunity in the market, I'm going to go after it, and here's how I'm going to do it. Okay, that I can engage with. But telling a long story about, Europe is interesting and blah, 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 particularly for these kinds of investors, that's a waste of time. Getting to the main point. Does that answer the question?
I think it's great. And what about strong performers who you think, no, I'm not going to invest in those?
Yeah. Sorry, I forgot that. Well, past performance is not an indicator of future performance. I think we've all read that on some book, right? And so what I'm always trying to figure out is, if you had an amazing success in the past, are the conditions that made that success still present, or can we underwrite, right? So in a way, all of us investors, we're only as good as our last deal, in a way, right? So if, for example, maybe there's a firm that's performed strongly, but sometimes the people who ran it are not really engaged anymore. So that would be, maybe they got wealthy. They earned so much carry that they're now on boats and planes and doing fun things. So that would be one reason to say, well, I don't really feel comfortable because I'm not really investing in the firm that generated that amazing result. I'm investing in something else, right? The reverse can also be true. You can see a firm with not very good past performance, But because they've adapted, they've learned, they've enhanced their team or whatever, you could have a strong conviction that the future would be great. So this is a very hard thing to do. You invest, as all of us as investors, we invest for the future, not for the past. The past is only interesting as a guide.
Super interesting. Now, thank you for this. And Pavel, to you question. So you have both goals when you invest in VC funds. You look at financial performance, but also in development impact. And I'm sure there are some tensions sometimes in the decision-making room, how to balance this, and also how to balance this with other co-investing LPs. So how do you navigate this?
So I think there is not that much tension, to be honest, and I'll try to explain why. Because the objective of the bank, of EBRD, is to, well, the impact that we target is basically development of well-functioning market economies, right, of private sector development, etc. And that is quite a specific type of impact, I would argue, which in our business, in the funds business, it's really, it translates into trying to develop the venture capital as an asset class, actually, in the region. And to be able to do that, you need to have successful fund managers, successful funds with, attractive track records, attractive operations, right? So I would argue that actually in our business, in the funds investing business, which it may be different from other types of business that the bank does. In our business, the development impact, developing the market basically, and the commercial returns, those things are very strongly correlated. I think one needs to understand it in the context of where we are in our region. In the EBRD region, the issues are, obviously the sector is still quite underdeveloped relative to the UK, US, or Asia, for example. Although there is a huge potential, I think, especially because of the amazing technical talent in the region. But it's still somewhat, at least parts of it are still somewhat under the radar of the sort of the global investors. The fund sizes are still too small, basically, often for global investors, global LPs to allocate to the region, although there are important differences. And, actually, Isomer is investing in our region, for example, right, quite actively. So it's changing, it's improving, but it's still quite underdeveloped relative to the UK, for example. And the key challenge is really the lack of private institutional investors allocating to the asset class, which I suppose we heard it this morning that it's to some extent, at least at the private, at the local level, it's an issue even in the UK. But in our region, it's both the local and the global private LPs, which are still basically under investing in the region. And so our role is really to try to attract or to crowd in those private institutions into the market. And to do that, we need to invest in the best, in fund managers with the best potential to generate attractive returns, develop, sustainable, long-term sustainable operations, and ultimately, basically, be able to raise funds without the need for IFIs like EBRD or EIF.
No, this is great. And Giuseppe, you have very different targets, I guess. So, and you represent private clients who probably look at VC as a completely different target and goals and so on. So how do you balance this? And do you see whether venture capital, general partner GPs understand actually what this segment needs?
Okay. In general, I'll start from the end of your question. No, they don't. So that's the first statement. It starts with a myth, which is large ultra net worth individuals, large family offices, they are called patient capital. That's absolutely not true. Right? These are the least patient person on the planet. And that's for a very good reason. So the point is the GP needs to understand this. He needs to understand he's talking with someone who invests his own money. Now, we go to school, we have heard this thing called behavioral finance, but then when we go in, we hear the pitch, people forget that. What we know is very simple, right? If you have a loss of 20%, for an institutional CIO, he just adjusts a little cell on a spreadsheet. That's very simple, right? A loss of 20% is not compensated, or is barely compensated by a gain of 40% in the brain of a human being, right? So that's, if the GP doesn't show empathy and patience, oh God, a lot of patience, talking with this individual, if there is a loss, he will have to be there, be present, business as usual. This is not going to cut it with these guys at all, and just explain every single time what they will do, how are they going to handle it, what happened, what is the path forward, etc. Every single time, right? So if the GP has whatever 20, 30 companies in the portfolio, that's a lot of discussions very often. The private individual requires a very intense form of communication, probably. That's the best way to say.
Oh, great. No, I think this is very useful to know. So, and Mark, maybe the question to you, like, you act as a catalyst of creating new funds, and sometimes without you, some of the funds probably would never come to life. So how do you see your role, and how do you see also, again, co-investing with some existing LPs and forging this ecosystem?
Yeah, one of the things that we're trying to do at the bank, we're trying to create this additionality of our money. So we're not just putting money into the market, we're actually making a difference and changing things. Some parts of the bank operate on a much more kind of ruthless commercial basis, trying to make money. My part of the bank, the development bit, is trying to do this, and additionality comes in kind of many ways of how we do this. So one of the ways is by encouraging other LPs into backing early stage emerging managers, because it's pretty challenging. Fundraising is very, very difficult. I was talking to one on the way in. It's just hard. It's really, really hard. So we do that in multiple ways. One of the ways in the ECF program, which has now been going for 20 years, is that we give away some of our upside to the private LPs. Joe's benefited from a bit of that in the past. There you go.
Don't stop the music.
But it is important to try and bring people in and serious LPs into the market so that we can actually close some of these funds. That's a really, really important thing. And actually, what does success look like on that metric? It's, I think just on the stage before you had Max from IQ, and we all think about Max and what they do as a kind of really established fund manager, deep tech, raise loads of money and everything. Actually, the ECF program, they had a £30 million fund in 2006. They started with a £30 million fund. They made a huge success. They had a £50 million fund. They made a huge success of it. I don't know what they've got under management now, maybe £1 billion or whatever. That's success for us. We maybe didn't benefit economically in the first couple of funds, like you might have thought we'd done, but we've launched a fund manager into the market, which is established and very, very important. We've done that with other people. Dawn Capital, Entrepreneur First, Episode 1, Concept recently. The list goes on of people that we've backed. I won't tell you about all the ones that failed. That's success for us, and that's a huge amount of additionality, and that's really important. What we're doing now, what's really important to us, is trying to diversify the UK landscape a little bit and bring new entrants into the market. So we got some money from the government to be able to kind of back underrepresented GPs, so people from diverse backgrounds, whether that's gender, ethnicity, social, economic. And over the summer, we'll be launching or closing 10 micro funds of people that just couldn't get money in the market. So we'll be encouraging other LPs to come into them. We think that they're amazing, talented, wonderful people. That this is not, we're not taking it easy. We are looking for brilliant people. They've just not got that friends and family network to be able to raise money. So seeing them in the market in 10 years with a, 200-300 million pound fund and being successful will be amazing. But we're prepared to take a risk on them. So yeah, we're doing lots and lots of different things. We understand, though, that being the biggest LP in venture comes with an enormous amount of responsibility. You said funds won't get raised. A lot of funds don't raise without us. We see hundreds and hundreds of pitch decks every year, and then disappointingly, the ones that we don't do, a lot of them don't raise. Most of them don't raise. It's really, really challenging. So with that responsibility comes an enormous opportunity to raise new funds with new managers, but it's difficult because we'd like to see more people coming into the market to back these. So.
But let's stay on this point. I think I will ask one or two more questions, and then if we have time, we will take one or two questions from the audience. But on this question, so when GPs meet, there is a lot of conversation around the market currently failing structurally emerging GPs. And I think, Mark, you are doing a lot of work actually to make sure that it's not happening. But the perception is that majority of capital is flowing into established platforms for good or for bad. But can you maybe briefly give your opinion on this and in whatever order? It's a question to all of you.
There's very few LPs that want to come in at first close. So when you're raising a fund for the first time, first close is super, super important, and trying to get to the right fund size. There's actually very few that want to now. More and more have realized that if you come in at second close, you don't have to do any work. People will have done the work for you, and you can just, with the funds closed, and you come in and go, okay, it's a real fund now. I'm not wasting my time. With emerging managers, you run the risk of doing a lot of diligence and them not actually closing a fund. So finding first close investors is really difficult, and that's a structural problem that we've got. Because as investors become a little bit more experienced, they're realizing, well, let's just go second close and see what happens. That's causing a problem because they're not getting to a second close. So that's a bit of a problem that we've got in the market with LPs and structurally. I think there's also a lot of new entrants into the market. We've been trying to crowd in pension funds for a while. I don't know whether there are any in the market, but they're very new to this, and it's new and it's scary. It's a scary industry to get into, and diligence in emerging managers and new VC, just VC in general, is not easy, and it takes a long time, and they haven't worked it out yet. So structurally, they need help. They need to ask for help, maybe. There are people that will help them. At the moment, I think they're kind of trying to work it out. They don't have the right people in place, and it's not an easy road. It's not an easy road.
But maybe a question to Giuseppe: do you have a lot of private clients who would love to invest in an emerging manager?
Well, yes and no, meaning that I don't think there is a fundamental problem with emerging managers, but no major bank will put an emerging manager on the platform. Very, very simple. We need 100, 500 million allocations, right, to make the operational effort worthwhile. An emerging manager, and we cannot be the only investor. Actually, we can't even be the biggest investor. So here we go. That's usually we would say we need to be not more than 10% of the fund. With that size, you have a certain limitation. I actually see it as an opportunity because the emerging manager should not waste time chasing the UBS, the JP Morgan, the Julius Baer, whoever. Should focus on the family office, the high net worth individuals, the potentially very small wealth management platforms. Because for these guys, I mean, actually going back to the point of Mark, you see that actually you can make more money with emerging managers because they are highly motivated than with a oversubscribed brand name fund, right? Sometimes it's easier to make 4 quarters than rather one buck. So that's and an individual person can put 2-3 million into the fund. We can't, right? I can't justify to the bank putting 10, even 50 million in a fund. That's way too small.
Now but let's talk about then returns. And Joe, I want to come to you then, DPI, right? So DPI is the elephant in the room, and it became more critical recently. So we hear demands to produce DPI, maybe sacrificing some of the long-term returns. So how do you see this, and how do you handle this in your portfolio? What advice would you give?
Yeah, that's a big topic. Am I allowed to come in on the emerging manager issue?
Please do.
Because I'm burning
Yeah,
up over
please
here.
do.
Well, I get really cranky when I hear all this complaining about the markets not supporting the emerging manager. Nobody owes you a fund. Just like with a founder, nobody owes you a company. Only through hard work and creating a compelling proposition can you succeed. And what I know is that if you have a compelling proposition, there is money there for emerging managers. We backed a solo GP last year. We couldn't get in. It was wildly oversubscribed. There's plenty of money there. That's not the issue. So I think the work you've done is amazing to create the landscape. We've done it too. I mean, you've come into managers we started. So, you know, that's really working. But let's be clear, nobody wants to back an emerging manager. Everybody wants to back a great manager. That's a different thing, right? So I'll give you a real example. Our highest performing funds out of the 100 we've invested in are all small and all early funds 1, 2, 3. Had an email from a manager yesterday. They sent us a distribution which is more than 4x the fund in one check, right? Just to give you a sense, right? That fund's at almost 20x. That's an emerging manager, small fund. So that's the crazy performance that you can seek, and it's hard to find, but it's possible.
Just on that, I think the key thing to this is building a portfolio, because the risk reward of backing one fund is difficult for people to get. So you need to build a portfolio. And back to your point, if you're writing lots of 3, 4, 5 million pound checks, you need plenty of money to build a portfolio. So this kind of conundrum. There aren't actually enough Isomers in this world for emerging managers. There's very few institutional kind of grade LPs that are prepared to build a portfolio of emerging managers and early stage ventures.
Well, that's why we do what we do, so pension funds don't have to be scared, so they have a lower risk route. Yeah.
Still scared though, aren't they?
Sometimes I give up on them, and sometimes I'm enthusiastic about them. But the DPI point, right? So VCs generally were always trained to ride your winners. So if you manage to invest early in a really exciting company, you should hold it forever until the IPO at 900 billion or whatever, right? Well, when you set up a fund, you enter a new business called fund management. And this is one of the challenges of emerging managers. They don't all understand that. So you do have a duty to return capital to your LPs. I have the same duty. So there is definitely a trade-off between holding forever. We all know private companies stay private longer. It takes a very long time to build a unicorn. It takes a very long time to IPO. So what's great today versus 10 years ago, you have more opportunities than ever to sell parts of the company on the way. So some of the biggest AI companies, the hottest names in Europe, we've received cash out of those in the last 2 quarters because GPs have finally figured that out. In 20 and 21, we were on an upcycle, and I was having this argument with VCs every week. Sell something, 10%, 20%, de-risk, take some money off the table. And we lost the argument every time. And nobody did. And, you know, we have a DPI problem in Europe. No, frankly, we can name names if we want, right? Right now, people learn the hard way, and now they are selling, and so there is definitely a dial you can turn between selling everything and selling nothing. But if you know that LPs value DPI, give them what they want.
No, I think it's great. I think we have signs that we are kind of like running out of the time, but can we take 2 questions? We can take 2 questions, please, I guess.
Thank you so much for the great panel. I'm Kevin from Execution Capital. One question for those LPs investing in emerging managers. How do you value and evaluate value add to the portfolio companies?
If you want me to be quick on that, we reference you with the portfolio companies that you've dealt with. We asked them what you did, what you didn't do, how you did it, whether they liked you or not. That's a really good starting place. You tell us what you think you do, we find out what you actually did do, and if it corroborates, we might be interested. So that's one way of doing it, yeah.
I think we have one more.
Yes, so as LPs, what is the IRR that we can expect over the life of like the PE and VC funds? Let's say like over a period of 10 years, what is the IRR that we can expect? And according to you, it is a good number which has been achieved.
Good question.
A long time ago, I was an investment consultant and investing broadly in private markets. And what we would always say is you should be able to beat stock markets by at least 5%, right? 500 basis points over long run in a distributed, diversified private book, venture, buyout, real estate, secondaries, whatever. Why do we do venture? Because we think we can significantly exceed that. So you should be beating 20%, I would think. It's hard to do, it's easy to throw out a flippant number, but if you diversify well and have a mix of assets, you can do, I would say, at least 15, try to get over 20.
I think we have one more question.
We've got one at the back here, if you don't mind.
Hi, this is Shubhanga. Kind of fit into the emerging manager profile that you're referring to, but I run a fund in India. And it is interesting that UK and India have had their FTA recently. EU and India also announced an FTA earlier this year, calling it as the mother of all deals. But what we don't see as an emerging manager sitting in London, investing into Indian ecosystem, is institutional LPs really looking beyond EU and UK. So what I want to understand is how are LPs like yourselves thinking about emerging markets, especially India, in the backdrop of the FTA that has happened, and how do you think capital can actually flow through emerging managers like us into the Indian ecosystem?
Well, maybe I start. So, look, the secret of raising money is knowing to whom you are talking. Focus your effort where you have the highest probability of conversion, right? So, don't go to EBRD, for example. That's or to even British Business Bank. That's outside their mandate, right? They will not give you the money. And frankly said, many, if I look at the banks, excluding a bit the emerging market topic, we don't like geographic-focused funds, right? So that's because, again, we are killing the diversification concept. And so that's, so we are also probably not the right partner. An Indian bank possibly is a different topic, right? Because then they replicate what some of the colleagues here are doing, right? Maybe, yeah.
Well, actually, just I wanted to quickly respond to this. So obviously, we don't invest in India, so that's indeed would not be a good match. But on the geographically focused funds, I just wanted to sort of pick up that point. I think, I mean, I would slightly disagree on that point because, of course, there are trade-offs, right? But in some cases, especially at the very early stage, it actually, in my view at least, it makes sense to have at least maybe part of the portfolio focused specifically on a, and with a particular knowledge and on the ground presence, etc., in a particular part of the world. So just to be at least slightly controversial.
That's fine. In our case, it will end up being in North America, and of North America, it will be the US.
So, and maybe just to close this conversation and this panel, I will ask you to give one sentence advice for GPs raising funds in 2026.
Stop listening to your friends. Listen to people that might not like your proposal so that they give you real feedback. The number of people that come in and go, oh, everybody I've spoken to likes this. Well, if you've spoken to people that just say yes. So put it in front of people who will be critical of you and take that feedback as it's meant to be. If you can't take feedback, you will not get very far in this industry.
I would say start early, or if you are to approach us early, because often it takes a lot of time to build conviction as an LP. We are investing in teams, right? So it takes time to get to know each other. Focus on, be clear about the, sort of the
One
strength.
sentence,
Ah,
one
okay.
sentence.
And maybe so on the tailoring sort of the proposals, I would actually, again, to be maybe slightly controversial, listen to the feedback from the LPs, but maybe don't try to sort of over-tailor it to what you think the LP wants to hear, because in the end, we need to invest in something that you are good at and you kind of know how to do and you believe in.
One sentence. Know to whom you are talking and what they want.
Perfect. Joe?
I'm going to copy Mark. Listen to the people who don't like what you're doing, use that to get better, and stay enthusiastic about what you're doing. Because I'll tell you what, if you're not enthusiastic, nobody will be.
Perfect. Thank
Good
you
luck.
so much. Thank you so much for this panel.